Here's something most finance channels won't tell you. Dollar cost averaging is mathematically inferior to lump sum investing. Vanguard proved it. Lump sum beats DCA 2/3 of the time historically. So why do I still use it? Why do most serious investors still recommend it? Because investing isn't just math. And today, I'm going to show you exactly why the strategy that loses on paper wins in real life, and how to set it up so you never have to think about your investments again. In the next 8 minutes, 3 things. First, what dollar cost averaging actually is, and the real Vanguard data behind how it compares to lump sum investing. Second, why the math doesn't matter as much as you think, and the psychology research that explains why. Third, how to set up a fully automated DCA system in under 10 minutes so your investments run on autopilot every single month without you touching anything. Dollar cost averaging is simple. Instead of investing a large amount all at once, you invest a fixed dollar amount at regular intervals, weekly, monthly, or every paycheck, regardless of what the market is doing. $500 on the first of every month into VOO. That's it. When the market is up, your $500 buys fewer shares. When the market is down, your $500 buys more shares at a discount. Over time, this averages out your cost per share. No guessing, no timing, no watching CNBC every morning hoping for the perfect entry point. Now here's the part most videos skip. Vanguard analyzed lump sum versus DCA across US, UK, and Australian markets over decades. Their finding? Lump sum investing outperforms DCA approximately 68% of the time after 1 year. Over a 30-year period, that number rises to 85%. The reason is simple. Markets go up more than they go down. The S&P 500 has been positive 73% of all calendar years since 1928. If you have cash sitting on the sidelines waiting to be deployed through DCA, statistically you are buying at progressively higher prices, not lower ones. The math says invest it all now. Why DCA still wins for real people? So if lump sum is mathematically better, why does almost every financial planner still recommend DCA? Because humans are not spreadsheets. Vanguard's own research shows that investors who invest a lump sum and then watch it drop 20% in the first month frequently panic sell at the bottom. They lock in losses, they sit in cash for months, they miss the recovery. The math of lump sum only works if you hold through the volatility. Most people don't. Dollar cost averaging removes that decision entirely. You never have a big scary number at risk on day one. You never face the psychological moment of watching your entire investment drop. You stay invested, and staying invested always beats the perfect strategy you abandon. Remember I said DCA loses on paper 2/3 of the time? Here is the other side of that number. 1/3 of the time, when markets drop right after you invest, DCA wins significantly. In 2022 was one of those years. The S&P 500 fell 18%. An investor who put $50,000 in on January 1st, 2022, watched it become $41,000 by year-end. An investor who DCA'd $4,167 per month through the same year ended up with a slightly better average cost per share, and more importantly, stayed calm enough to keep investing through the entire decline. The DCA investor didn't flinch. The lump sum investor often did. Here is how you set up dollar cost averaging so it runs completely automatically. Step 1. Open a brokerage account if you don't have one. Fidelity or Schwab. Link in description. Step 2. Choose your ETF. VOO, VTI, or SCHD. We've covered all 3 on this channel. Step 3. Set up automatic investing. In Fidelity, go to Accounts, to Automatic Investments, set your amount and frequency. In Schwab, go to Accounts, Schedule Transactions. Step 4. Set up automatic transfers from your bank. Align it with your paycheck. Step 5. Never look at it. Set it, forget it, let it compound. The power of consistency, the math. The aha visual moment. Here is why consistency beats everything. Someone who invests $500 every month for 30 years into VOO through every crash, every recession, every panic headline ends up with approximately $986,000 at 10% average annual returns. Someone who invested the same total amount but paused contributions during every market downturn, missing just the 10 best days in the market, ends up with roughly $453,000. Same money, same years. The only difference? They stopped when it felt scary. DCA makes stopping almost impossible because nothing ever feels scary enough to justify breaking the automation. DCA in a Roth IRA and 401k connects the content web. Here's how dollar cost averaging fits into everything else we've covered on this channel. Inside your Roth IRA, max it out at $7,500 per year by setting up automatic monthly contributions of $625. That's DCA inside the most tax-efficient account available. Inside your 401k, your payroll deduction is already dollar cost averaging automatically every paycheck. You're probably already doing it without realizing it. Add your VOO or CHD holdings in a taxable brokerage account on the same schedule, and now 3 streams are compounding simultaneously, all automated, all tax optimized. Common mistakes. 3 mistakes that kill DCA returns. Mistake 1. Stopping during crashes. This is the single most expensive mistake individual investors make. The months that feel the most terrifying to invest are statistically the best months to buy. March 2020, October 2022. Every major crash in history. The investors who kept their automatic investments running through every one of those periods came out dramatically ahead. Mistake 2. DCA into individual stocks instead of index funds. DCA removes timing risk but not company risk. A single stock can go to zero, an index fund never has. Mistake 3. Investing such a small amount it doesn't matter. Even $50 a month matters. Start where you are. Increase it every time you get a raise. Let me close with the number that settles this debate permanently. JP Morgan analyzed 20-year periods from 1950 to 2020 and found that missing just the 10 best days in the market cut returns in half. Missing the 20 best days reduced returns by 2/3. The tragedy is that the best days in the market almost always come immediately after the worst days. The people who tried to time the market and sold during crashes missed the recovery. The people who had automatic DCA investments running never had to make a decision. They bought on the bad days automatically, and those purchases, the ones that felt the worst, were the most valuable ones they ever made. Dollar cost averaging is not the mathematically perfect strategy, it is the humanly perfect strategy. It removes emotion, removes timing, removes the decisions that destroy most investors' returns. Set it up once, let it run for 30 years. Drop the word automated in the comments if your investments are already running on autopilot. And if this video helped you think about investing differently, hit like. It takes 1 second and helps more people find this channel. Next Tuesday, I'm covering why your 401k alone will not retire you and what to add alongside it to close the gap. Subscribe so you don't miss it. See you Tuesday.